Good morning and welcome back to Almus Market Mornings. Quite an eventful day yesterday. The meeting between President Xi and President Trump came to the expected conclusion of a truce in a trade war. China has eased up on its rare earth regulation while US has eased up on tariffs. But interestingly, just before this meeting, President Trump announced US will resume testing of nuclear weapons because China and Russia seem to be doing so. This is happening after a gap of almost 33 years. And on the central bank front, ECB and BOJ kept rates unchanged in yesterday's meeting. But let's understand more from JK. Good morning, JK. Going into the weekend, it seems that a resolution of one issue and there is a creation of another worry for the markets with the nuclear testing. What's your take on this?
Morning, Swaraj. Quite an eventful period we had. In little over 24 hours, we had four central banks meetings, and then trade talks between the US and China, and as you said, a fresh geopolitical concern for the market. So the trade talks, of course, went on almost expected lines, with Trump agreeing to reduce tariff by about 10%, and in exchange for China importing soybeans, as also resuming export of rare earth materials. So that was not a surprise for the market. Perhaps they expected more, so there was no a bigger positive reaction from the market. Market was already reeling under the disappointment of Powell's statement saying that December rate cut is still quite uncertain and it's an open question. In fact, there has been a criticism once again, not unexpectedly, from the US Treasury Secretary, who says that Fed is still stuck in the past, and in fact went on to say that we are going to find a new leader who is going to revamp the entire situation in terms of process and inner workings of the Fed. So definitely, this is not taken well by the administration, which is looking for Fed to cut rates. In a bigger measure, market, of course, is disappointed, but still expects a cut. Probability is now at 71% for rate to be cut by 0.25% in December. And I'm somewhat surprised by the statement from Powell also, because with the government shutdown now almost a 1 month old, and nearing a record longest period of shutdown, I think the impact on the economy is not going to be positive. It's definitely going to be more negative. So I would have expected Fed to be leaning on dovishness, but their Powell statement has really surprised me. If it can only be justified if there is going to be bigger inflation number that we are going to see. But again, there is no official data also available on that. In any case, market has reacted negatively on the Fed statement. And on the geopolitical concern, while Russia has now denied about any nuclear drills and calling it as provocative misinformation, market will remain cautious after Trump called for the U.S. Side to start the nuclear, tests. So that definitely is something that will run in the back of the mind for the markets. Bank of Japan, again, no surprise. By 0. No surprise by holding the rates at 0.5%. More disappointment for the market was that Ueda, in his press conference, also was not much hawkish, although there's some indication that the move can come in December. If you look at today's data, Swaraj, we had an inflation number that beat last month's number by a large mile. 2.5% was now at 2.8%, both on headline and CPI in Tokyo region. And Tokyo region inflation is kind of indicative of the larger trend in the economy as well. So it's becoming increasing. And not only that, the retail sales and industrial production were quite robust also. So it's becoming increasingly unjustifiable for BOJ to hold rates. I feel that December rate hike, if it is not done, I think it's going to be question by even the US, who has already pointed out that Bank of Japan should act on the monetary policy, to control the inflation as well as to address the weaker yen. No doubt, I feel if yen crosses 155. There is a definite threat of even intervention, because I don't think Bank of Japan is, wanting much weaker yen from these levels. Then, of course, we had ECB, which has also held the rates unchanged at 2.15%. That is the repo rate. But I think their statements on inflation being met in the course of the year, as well as growth to remain on track or somewhat strong, indicates that the rates are almost at the bottom. And in fact, that is indicated by the Eurozone yields also slightly moving up. Of course, we've also seen the US yields now up. On the 10-year is almost like 18 to 19 basis points up from the bottom that we have seen recently. Of course, the Bank of Canada also had cut rate by 0.25%, but possibly that's the bottom for the rates now. So all the four central banks have acted in line with the expectation, but their statements have been more provocating more reaction from the markets. Yesterday, of course, the stock market in the US for the first time reacted negatively to higher capex spending by big tech companies, worrying about earning prospects of these huge investments. This is the first time that we have seen there's a negative reaction. The Nasdaq was down, although Dow ended in the positive territory. As far as the dollar is concerned, all the factors pointed to some recovery in the dollar, starting with Fed statement, China, US trade talks having been well discounted, then the geopolitical concerns, BOJ holding rates, and then yen moving towards 154.50. And in UK also, let's note that they are expected to cut rate when they meet next week. And there has been, for the first time, there is a downgrading of productivity in UK economy, which has been seen as a trigger for Bank of England to cut rate next week. So all in all, an atmosphere of strengthening dollar, and of course the year-end factor also might be in play, because dollar has been weakening for almost 6 months now, and normally that is seen that towards the year end, larger players tend to size down their positions, and that also can lead to some more strength in the dollar. The medium term view still remains one of weakness, but I think short term technical bounce in the dollar is very much on the cards. Dollar index now actually trades above 99 as well, which has been resistance for some time. Yes, a lot of action in India also, because the rupee, which was expected to be well contained at 88.30 or maximum 88.50, broke both the resistances with ease. And obviously, no central bank's strong presence was seen at these levels. So month-end demand was no doubt a factor. But also, I think a larger factor was that the market was holding short positions, expecting the resistance levels at 88.30 and 88.50 to contain, and RBI to intervene at those levels. Let's also remember that last time when it was at 88.50, RBI had intervened massively to bring down the rate as low as 87.60, but then the bounce from there towards 88.70 seen yesterday is somewhat surprising. Now, question remains whether they return at 88.80 to contain the rupee weakness. I think they will, because the rupee still looks undervalued, at least from the trade deal point of view. There is more optimism that is building, and so I think they will hold the market at these levels for some time. Two things that we will look out for is whether the dollar index continues to make larger gains, and also maybe we'll also look at the state election result that is coming up in the in the first 10 days of November. So it may not be immediate reversal for the USD INR. We trade in the higher range between 88.40 and 88.80 for some time, awaiting how the dollar behaves and also the political events. Thank you.
Thank you, JK. And before we go to the conclusion, just a question, JK. This state election which you mentioned, this is Bihar election, right?
Yes, that's right. Yes.
So currently it's been ruled by a NDA coalition, right? Like the NDA member.
Yes.
So,
Yes.
so if we are
Yes.
seeing any sort of breakdown over there with respect to NDA, that
Mm.
can be negative rupee, right?
That can be negative for the overall market, because if you look at the overall composition in the uh, parliament also, the major party is having a lesser number, so we are having actually a coalition government there also. Yeah. So a loss in, I'm not predicting anything, but setback there could be seen as some sort of a negative factor for the markets.
Understood. Understood. So, folks, that's what we have to look forward to in the next month. But broadly, central banks yesterday have acted in the manner which was expected by the markets. Bank of Japan did not raise rates, but interestingly, the inflation is going higher in Japan, and that's sort of increasingly keep becoming necessary for the BOJ to raise rates, because even other high frequency indicators like retail sales are coming out strong. So there's a strong economy. Inflation is also rising. No reason for you to keep rates at 0.5%. And the case for raising rates just becomes stronger. On the other hand, ECB, they have kept rates steady. Seems like ECB may be done with the easing cycle. The inflation is steady. Growth is recovering. So further support may not be required at this moment. Even Bank of Canada, which cut rates, they have indicated an end to the easing cycle. So broadly, we are seeing some major DM markets close to the end of this easing cycle, and how that plays out, we will see in the times to come. Otherwise, rupee and the domestic markets had a big move that weekend towards more than 88.70 actually, primarily due to month-end demand. The resistance at 88.30 and 50 for the USD INR, which was expected to hold, it did not, and this bounce has surprised many in the markets. Now, whether RBI contains rupee at likely, it's not whether, it's likely that RBI contains rupee weakness at 88.80, and let's see from there. Thank you for listening. We'll catch up. We'll catch up on Monday with the fresh round of updates. Have a very good weekend.